This is Alan Bush with the Daily Financial Forecast for Tuesday, July 28th. In the stock index futures, we are seeing prices a little bit better this morning, and it looks like some of the strength may be linked to the consumer confidence report that ironically did come in a bit weaker than expected, in fact quite a bit weaker than expected. Now normally this would be considered to be a bearish influence on stock indices, but futures firming on the belief that anything that suggests a weaker U.S. economy could influence the Federal Reserve to hold off on a rate increase. So that is supportive to stock index futures. Also, we do have a major double top pattern in the September S&P futures at historical highs. So I believe that just because of that double top pattern, anyone that is short will probably be putting buy stops somewhere above that point, and that would be the historical highs that we saw several weeks ago. So longer term, still looks like stock index futures can work higher. Now, moving over to the currencies, the dollar index actually fell yesterday at a time when many analysts thought that it should have rallied. That was with the 8.5% drop in the Shanghai stock market in China. And yet today, somewhat of a recovery, a rather limited recovery. So overall, I'd have to say that the dollar index is not performing very well on bullish news when we do have bullish news for the dollar index. Also, with the consumer confidence number coming in weaker than expected, the strength that we saw in the dollar being diminished again after that report came out. Over in the pound, some gains with the UK GDP for the second quarter coming in up 0.7% as expected. And it now looks like, according to the financial futures market, that the Bank of England is on track to raise interest rates in May of next year. My personal feeling is that they will not be able to raise rates, but the perception of higher rates is supporting the British pound. Also, the commodity currencies, the Canadian dollar and the Australian dollar, holding up very well over the last couple of days, even though we have had some rather severe weakness in some of the commodity markets, namely crude oil. So with the Canadian and the Australian putting in a performance better than expected in light of weaker commodity prices, that could be a sign that those two currencies, the Canadian and Australian, are nearing a bottom. That also could be an indication that we are near the end of the free fall in crude oil prices. Now, moving over to the interest rate markets, there had been some fairly good gains in light of what has happened with Greece and the Eurozone as flight to quality longs were established. Some follow-through strength on weaker commodities. But now today, pressure developing. There seems to be, I believe, some pressure developing due to a rather large amount of Treasury supply to be sold this week. In fact, there's $105 billion in offerings from the Treasury for the entire week, with $26 billion in two-year notes to be sold today. So longer term, I think that the long end of the curve will work lower. Ultimately, I think we'll take out the lows that we saw about 5 or 6 weeks ago in the 30-year bonds, and I think that will be the main trend. So once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland. So good trading, everyone.
That's 11314.